This man never made more than $90K a year, but he died with $5 million in real estate. And here's how he did it in real estate without stocks, crypto, or business. Hey friends, welcome back to the Wealth Planning Podcast with Brister Law. I'm Anthony Bister, and today's episode is one of the most foundational ones that we'll ever do because we're unpacking the question, why rental real estate? Why do I believe, after helping hundreds of clients, reviewing thousands of tax returns, and building my own portfolio, that rental real estate is still the number one wealth building tool for everyday Americans? Well, let's break it down. I'll start with a story. So back when I was just starting out, I met a man at a networking event. Let's call him Joe. Joe wasn't flashy. He didn't wear a Rolex, and he drove an old pickup truck. But when I asked him what he did, he smiled and said, I just own a few rentals. Been buying one or two every 2 or 3 years since the 90s. Later, I learned that Joe had over $5 million in paid off real estate. His tenants had paid down every mortgage. He had never made more than $90,000 a year from his day job. And from that moment on, everything shifted from me because Joe wasn't lucky. He was consistent, and he used the 4 pillars of real estate that I'm going to teach you about today. So let's break down those 4 pillars one by one. First up, we've got appreciation. Real estate tends to go up over time. Yes, there are dips, but over the long haul, value rises. And it's not just about inflation. It's about demand, scarcity, and location, of course. For example, a home bought for, let's say, $200,000 back in 2010 in Houston, it's probably worth $350,000, $375,000 today, depending on the area. That's over $150,000 to $175,000 increase without lifting a finger. And that's the power of owning real estate and owning a real appreciating asset. The second pillar is debt pay down. If you use a mortgage to buy your property, and most people do, guess what? Your tenants are paying that off. So each rent payment chips away at your principal. Every month, you own more and more of the asset with less of your own money. And so let's say that your mortgage is $1,500 a month. Over a year, your tenants would have paid off more than $10,000 of your loan. You multiply that over 5-10 years, and you're sitting on a ton of equity paid by someone else. Now, if this is starting to click, and if you're thinking, I want in, but I don't know where to start, head over to bristertaxlaw.com and schedule a free discovery call. We'll talk strategy, no sales, just clarity, or shoot me a message on Instagram at Brister Law Firm if you want to swap ideas or hear more case studies. Okay, so the third pillar we have are the tax advantages. This is where the magic happens and where my background as a tax attorney comes in. The IRS gives rental property owners a legislative gift. Depreciation is a way to deduct the cost of your property over time. So even if you're making positive cash flow, your tax return might show a loss. In fact, the average long-term rental shows a loss generally for the first 5 to 7 years on paper. And if you qualify as a real estate professional, or you use the short-term rental loophole or the self-rental loophole, you also can sometimes use those paper losses to wipe out your W-2 or active business income. And real estate is one of the only investments that pay you and lowers your tax bill at the same time. Then lastly, we have cash flow. This is the reason why most people get started. That monthly income. Your tenant pays the rent. You cover the mortgage, taxes, insurance, and expenses. And whatever's left is yours. Now, in some markets, that might be a few $100 a door. In others, especially short-term rentals or multifamily units, you could be looking at thousands per month in cash flow. And unlike flipping or trading stocks, this is repeatable income and money that shows up every single month. Mailbox money. Now, here's a problem. Most people don't get taught this. Your CPA doesn't explain it to you. Your financial advisor can't sell it to you. And well, the schools, forget about them teaching you this. So you work hard, you save, maybe even max out your 401k or up to the match, and you just hope that it's enough. But you never get taught on how to build equity, create cash flow, and use depreciation as a weapon to eliminate your tax bill. And that's the difference between being middle class and building true generational wealth. Look, you don't need to own 50 doors. You don't need to be a landlord full time, but you do need a plan. And if you own just 2 to 3 rental properties structured the right way, this could mean hundreds of thousands of dollars in equity and tens of thousands in tax savings and income that you can count on even when you sleep. Whether you're a doctor, a coach, a lawyer, or a full-time entrepreneur, real estate can be your wealth foundation. So let's recap. Appreciation builds your wealth while you sleep. Debt pay down grows equity without lifting a finger. Tax advantages let you keep more of what you earn. And cash flow gives you income and freedom. Rental real estate isn't just an investment. It's a tool, a vehicle, and a system. And it turns your income into ownership. And it gives you control over your future. And it's still, even in 2025, one of the most powerful, proven wealth builders in America. Thank you for listening to the Wealth Planning Podcast with Brister Law. That's why rental real estate. And if you got any value from this at all, please share it with a friend. And if you're ready to make your first or your next real estate move, let's talk. Because you don't build wealth by accident. You build it by design. And we'll talk soon.